Good morning, everyone. Good morning. Thank you for joining us today for this online market update that I'll be hosting with contributions from several of my colleagues. I'm pleased to say for the first time in a long time, the sun is shining as I look out through the window, so it must be the start of a half-decent day, hopefully. So I'm Alan Trelaw, and I'm a director at Vickery Holman with particular responsibility for agency across the firm. My daily working role, as well as director at VH, is a lead commercial agent, mainly covering Cornwall. We often start these presentations with a quick update on company matters. And if you don't know already, we have 4 offices: Truro, Plymouth, Exeter and Bristol. And from these locations, able to comfortably cover the southwest area. We employ around 80 members of staff who are widespread across the region. And how widespread our staff are means we've got people in most corners to cope with most things that people throw at us. In the past few years, we've seen sustained growth as we strive to meet our growth aspirations for the business year on year. And in the past 12 months, we've seen our board grow with 2 new appointments, and we put a great deal of effort in succession planning to ensure the longevity of the firm for the future. Some of this succession planning comes from enabling our graduate recruits to qualify in their chosen area of surveying and flourish with us. And we have graduate surveyors going through the RICS final assessment process this year. We're also, reflecting, I suppose, some of this employee focus that we have. We were delighted to be awarded Employer of the Year at last year's Exeter Living Awards, reflecting that commitment we have to all our staff. So now, moving on from the company stuff to the property part of the presentation, we're going to run this as a swift tour through various property types and sectors, with me drawing on the views of our staff, and then hopefully there'll be time for any questions at the end of what we plan to take approximately 1 hour. Please do drop any questions into the chat on the side of the screen. To set the scene before we start talking with my various colleagues, I'd just like to give a very quick overview of where I'm seeing things. And since we last held a market update, either online or in person, the market has come to terms with inflation, which has now reduced significantly in recent months. There is now serious talk of interest rates coming down, which once they do actually start to reduce, feels like the change that needs to happen, to take place, which is going to make a real difference to confidence and activity. In the retail sector, we've seen a mixed picture. We've talked about this a great deal before. Retail rents have gone through a readjustment over, many years now, meaning retail premises are affordable for those occupiers looking, but most activity remains in the coastal or higher value market towns, and also some activity in the city centre, which gives us a little bit of optimism. We'll talk more about that perhaps later. In the office market, we're now 4 years since the first lockdown, and we're now used to the fact that occupiers are now tailoring their requirements to suit what is often a workforce which is now working in a hybrid way. Most want the most convenient, best quality space they can find and afford. And I don't think we need to talk about sort of post-COVID or the new normal and all that sort of thing anymore, because we've now got what we've got, and we're pressing on, I think, with how office life now is. The industrial sector continues to perform well, perhaps not flying like it was 2 or 3 years ago, but the relative scarcity of available space and the strength of those businesses which occupy industrial space means rents remain at good levels, and prices, when freeholds do become available, are also strong. You only need to look online to see the relative shortage of freehold industrial premises on the market, which gives a big clue as to what that market's like. The property investment sector has had a relatively quiet time as bank interest rates have remained historically high, putting yields on properties under pressure. Though the yields on more secondary stock seems to have been a little more protected in our experience, and there have been investors looking to find property investments to put their cash into. And land, whether commercial or residential, remains in relatively short supply, which means there's always a certain amount of demand, but developers have pulled back to some degree over the last 12 months or so, as borrowing and construction costs have put their activities under pressure. We'll discuss the residential market in particular later, which does seem to be showing signs of improving, albeit still waiting for that movement in interest rates. And the leisure sector, so important to the southwest, is the last one which we'll discuss. And this has seen challenges due to the cost of living crisis, utility costs, and probably staff shortages as well over the past year or so. And we'll be coming into a new season very, very shortly, and we'll discuss market activity with our specialist, Mike Easton. So to set things off, I'd like to invite Joe High and Zach Maiden to the stage. Joe heads our general commercial activities, and works out of Plymouth, and Zach runs our agency activities in Exeter. So hopefully we can welcome Joe and Zach onto the screen with me for a few minutes.
Morning, Al.
Hello, hello. I think the first sector we were going to pick up on was industrial, and which I had said earlier is probably maybe the easiest market to summarise in some ways. But Joe, perhaps starting with you, is industrial still the strong sector that I think it is?
Yeah, definitely. Not much has changed. I think demand's still really high. Supply is low. We've actually got less being built in Plymouth than we probably have for a few years. So that only exacerbates the problem. I'd say rents have probably peaked for the minute after that sort of sharp rise over the last couple of years. So we're probably up at £10 a square foot maximum for the the smaller, better quality space. But then the 10,000 square footers, they're still probably £7.50, £8 a foot, because we don't have many of those either. Mm-hmm. So yeah, still a good picture in them.
And are you getting much? Is there much freehold coming on the market at all?
Not much. Odd bits, and the bits that do come on are going for pretty decent prices, and we're generally ending up with 2 or 3 parties wanting it, because mm-hmm. there's not much, and if there is new build stuff, that's obviously a lot more expensive. So yeah, good demand when it comes available.
You said about supply just now. Has there been a lull in new build? Is there more to come in the pipeline that's predictable, or is there just not a lot on the horizon really?
Not a lot on the horizon. There's a few bits out at Langage, but they're within the free port. So there's a gateway policy. You have to be a certain business to go into that. So the general industrial market, no, there's not. There's probably the odd bit here and there, but not much.
And you're involved with the development Cornwall business. Where are you involved in Cornwall Services?
Cornwall Services, yeah.
You've got some interest there in some of the new build that's proposed there, but that's at an early stage. That's still subject to planning and so on.
Yeah, so planning's in. We're hoping for that to come through in middle of June. So that's on the Cornwall Services side of the site. So we've got 4 units there, just under or just over 13,000 square foot. But once we've done that, we've then got 20 acres on the other side of the road. So we're seeing good demand, which unsurprisingly.
Yeah, that's good. Yeah, alongside the A30, I suppose. Where else would people rather be, really? Zach, what about around Exeter? Where are you at in terms of supply versus demand?
It's pretty much same as what Joe was saying, actually. There's just lack of actual supply in the marketplace at the moment. I know I said pretty much similar last year, but same again. There's still a little bit up at Soughton, but poorly configured units, that kind of stuff. Where else do you go, really? You've obviously got Sky Park Phase 2, which is freehold, 36 units up that way. Record prices are still actually being achieved up there, which is pretty incredible, really, despite the economy that we're in right now. But we're achieving £230 a square foot for those small 1,000 square foot units. BREEAM excellent, etc. It shows that our marketplace is still pretty strong.
Yeah, I think that rings true for the West as well. That the rates per square foot, whether we're talking rental or freeholds on the odd occasion when they crop up, is still remaining really, really strong, even if activity is not quite as heated as it was a short while ago, or 2 or 3 years ago now, as I say. But all those rents that we achieved are staying up there. So we're definitely.
They certainly are in Exeter, but that's because they're just so rare. Just barely anything actually comes to market, especially in places like Marsh Barton.
Yeah.
Actually, people are having to look further afield. Clumpton, like Mercury Business Park, Crediton, Oakhampton. It's just gone crazy. If you look at one we're selling in Marsh Barton at the moment, which is 10 to 12 Marsh Green Road, we're hitting over £1 million an acre now.
Wow.
Has a shed on it, but pretty basic shed, asbestos clad. It's just the rarity of having that kind of space coming up in Exeter and Marsh Barton in particular, that owner occupiers are jumping on them.
Yeah. Owner occupiers have been previously renting somewhere else, or they're in businesses that are growing.
Correct. Exactly that. They've already had an established business and then they're moving out. It's been pushed out a little bit on the development side, but I guess that's because build costs are so expensive. But there's still appetite from owner occupiers, so the value is still being held. which is quite interesting. But if you look at places like Oakhampton, we've just taken on a quite substantial site in Oakhampton. We're getting owner occupiers looking to bid on that too, because it looks substantially cheaper at say 200,000 an acre, outside of Exeter.
Yeah.
So even though the building is incredibly poor condition and poorly configured, people are still jumping on the opportunity, really.
Well, and at the price, I guess they're still prepared to take the compromises that building means and work with it still to refurbish it or whatever. Because it's
exactly
still
that.
presumably...
Yeah. The one in particular is a food production unit, so we are getting the food production guys, but also we are getting, any other occupier reconfiguring it for development. So it is quite interesting right now, and of course a lot of this is cash right now. So yeah, it's an interesting time for us down this way.
Perhaps a less easy sector to just present such a sort of straight line upward graph type of thing, whatever. I think we're moving on to offices next. It's on my list anyway. The office market, I've sort of said that, we've moved on from talking about post-COVID and, now is this the new normal and whatnot, that, we are where we are now. I think people are quite used to that probably, but I guess now, they're having lease events come up, or they've realized that they want more space or less space or better space or whatever. And that's sort of what is driving a bit of demand in the market, isn't it? And I think there's a few bits of new space here and there cropping up, like talking a bit further west, down in Liscard, we've got something for the county council, which has been completed quite recently, a little project called the Work Shed, and it's lettings there are going pretty well, and I think it's because there is that sort of pent up demand for certain types of space that you don't know quite what demand's going to be like until you deliver it, but it generally is quite satisfying what comes through. I don't know what your thoughts are on the offices in your bigger cities of perhaps start with you, Zach, in Exeter.
Yeah, sure. Well, as I've discussed previously, Exeter actually has a pretty low supply anyway, even before COVID, etc. So actually, we're lacking stock of good quality. Don't get me wrong, it's still a very, very tough market out there, and the majority of our products in the city are probably not going to let again, and they'll have to be repurposed. But what it does show is that only the best offices are letting, because they want to attract the best talent, best staff, and retain staff. And that's the most important thing here, as we are competing with the likes of Cheltenham, Bristol, Oxford, Cambridge. So, some of the stuff, I mean, there have been some good deals in our city centre, excluding Winsley Park for the moment, which is out of town. But, it is about the best space, and people are willing to pay, upwards £21 a square foot for office space, as long as it has the best ESG credentials. Now, I guess the flip side of that is it's very costly to refurbish. So, convincing clients to refurbish before guaranteeing them a tenant is tricky. Those are conversations that we are having right now. And then clients are saying, well, why would we do it if you're not going to guarantee us an occupier, or it's going to take 18 months to find someone? Well, that is the market.
Because I guess clients with offices all over the region really are, because like we're saying, these few years have gone by now, they're having to actually bite the bullet or do whatever it needs to be done to repurpose or whatever the redevelop or whatever the next step is for their offices.
I'll tell you what is interesting is actually serviced offices. They've gone quiet, which used to be, previously, only a couple of years ago, that market was booming, and now people want more traditional leases again. Maybe still flexible terms and incentives creeping in, but they actually want a designated traditional office now.
What about you, Joe? What's Plymouth like?
Similar-ish. I guess Plymouth has never had the best office market, so we've probably fallen back on that. Demand is much the same. We haven't got tons of supply. It's the smaller stuff where we're seeing the requirements, so sub 1,000 square foot. The council completed the ones up at Barratt Court, Plymouth International Business Park, and they're EPCs, solar panels, electric charging, heat pumps, etc. And they've gone really well. We've been getting up to just under £14 a foot for those, so which is pretty good considering our other out of town offices are probably anywhere between 8 and maybe 11.50 a foot at a push. It's the bigger stuff that is more challenging.
Yeah, similar rates to what we're achieving down here in Truro, I guess, really. You mentioned some of the more modern sort of bells and whistles there, and I guess it's almost common sense, I suppose, that people are drawn to offices with some of those facilities, more of those facilities these days.
Yeah, I think that's probably a bit of a change in the last 12 months, and maybe that's the, the energy costs going up. We've got to thank for that. But yeah, people are now looking at, what's the EPC and, how much does it cost to run it? Whereas, even 18 months ago, people probably wouldn't have thought about that.
And a bit of car charging, are they using that outside their offices, people, occupiers?
A little bit. Not everyone. I think it's still early days, but I think people do appreciate having it because they are thinking in the next couple of years or in the term of their lease, they probably will make the move to electric. So, yeah.
So if it's got that advantage, then maybe, even if just the boss can plug in or something.
Yeah.
Another sort of challenging sector, maybe retail. What's hot in retail? I mean, I said earlier that coastal towns, strong market towns, that sort of thing seems to have always performed well and continue to perform well for all of us, I suspect, across the region. Back to Zach, perhaps Zach, you would Exeter. We spoke, you and I, a short while ago about there being some quite reasonable activity, actually city centre stuff these days, though, for you think?
Yeah, absolutely. There's been quite a few little transactions actually for some big major retailers, and we've actually seen rents creep up a little bit of Zone A's, prime Zone A stuff, which I think was a little bit of a surprise. But those retailers are coming back quite strong. They've got multiple requirements out for regional towns in our patch, and the likes of the Cruise, the Salt Rocks, the Sea Salt, etc. are actually expanding. Edinburgh Wooler Mill's a pretty obvious one as well, and taking good size space in city centres or town centres in our patch. So yeah, it's looking quite promising actually.
And some of those are just new space or just improving on what they've got. When they've come to a deal,
they're improving on what they've got.
Yeah.
I should add the likes of Dartmouth, for example. We've seen rents even go up again, which originally actually kind of surprised me, thinking, okay, well, it's just a bit of it's the best shops going. But now actually we've got multiple deals where rents have gone up. And that was quite interesting, really, because it was only 6 months ago we had about 4 or 5 prime shops in the town. Okay, they all came up at the same time, but guess what? They actually went for at the asking and actually above that in some cases as well.
Are those occupiers in those? Are they, nationals or individuals or what? Who's
National.
taking? Yeah, they are.
But with a decent regional presence, that kind of, especially Cornwall, Devon, family businesses who are now, multiples. But it does also show that they come out of a spot, and then there's an opportunity for an independent, local family business to take that space. So.
Yeah, we're seeing more vacant space on some of our, what would have always been known as more attractive high streets in some of our towns down in Cornwall, but it tends to be the larger units that were once occupied by the, historically sort of prime occupiers, if you like, that are much harder to shift than the slightly off prime, really nichey, trendy, fashionable, whatever, lifestyle-y sort of stuff, which, all those kind of locations seem to be still chock-a-block with occupiers, but it's perhaps, I suppose, there's more expensive, larger ex-national boxes, which are harder to shift, it seems, this far down.
I agree. In certain spaces, Al, I think, in like a shopping centre, those big units, the former Wilcos, are difficult. Don't get me wrong. They were needed to be split up into smaller units. Like take Princess A, for example, the top shop unit is still vacant, but there are alternative uses looking at those as well. So swings and roundabouts. I just got to caveat what I said, because obviously the bigger stuff is still challenging.
Really big.
In the best positions, affordable rents are still key.
Joe, much to add on retail from your point of view?
Maybe the neighbourhood parades, they continue to perform well. We had a little one on Ebrington Street in Plymouth, only a small unit, but that we ended up going to best bids on, and had 6 leasehold offers. So, which goes to show if you're right spot, right rent, rateable value is perhaps below the threshold, so you can get your small business rates relief. That's still popular.
And the other thing which we sort of class under retail really is the whole sort of roadside retail and leisure, I suppose, sort of coffee and other food and beverage and that sort of stuff, roadside things. So that demand from that sector still seems to be as strong as ever, doesn't it? Finding the right opportunities to put such occupiers is I don't know, challenging, but there's a lot of the good spots have gone already, perhaps, but still those kind of occupiers are still trying to fill in locations where they're not, and it seems that every town that might have had one drive-through something or other seems like it's probably can stand a second drive-through something or other, isn't it? Almost certainly the demand that comes through to us anyway. So, but some of those deals were much longer in terms of planning and whatever. So perhaps not sort of things that we're going to see happen quickly, but I think that roadside demand, plus with a bit of EV charging now as well, that's not going to go away, is it? So hence on our slides here, we've got a couple of plots, particularly one big green one on the right-hand side there, which is a sort of roadside development plot. We've got some quite good drive-through interest in that. So it's part of that retail scene as well. So thanks for you both for those contributions for the moment. I think you're welcome to leave the stage for a sec while I just have a quick review of the investment sector before we move on. So in terms of investments, and where we come from at Vickery Holman with regards to the investment market, it was always a bit of a risk running something so close to Easter weekend, and our investment specialist Claire Cochrane unfortunately can't be with us today. So unfortunately I've going to steal a bit of Claire's thunder and give a few thoughts on the investment sector rather than she and I have a sort of a two-way conversation. I've put a few notes down to run through. But in short, the investment sector in the Southwest has proven quite resilient as far as we've seen over the last few months in comparison to a lot of locations, with investor confidence underpinned by a relatively strong occupier market. And you can, I suppose, get the sense from our chats about offices and industrial and retail just now about how well occupied most space is. And obviously investors can take an awful lot of comfort from that. 2024 looks like it's going to be a year of stabilisation, as there seems to be greater consistency in the economic projections. And whilst there's still challenges, the outlook improves as we move through 2024 towards what we hope is a further recovery in 2025. As we know, interest rates have been stable for some time now, and the expectation very much so is that they've peaked and will start to fall in the second half of the year, or possibly sooner. And though GDP for the UK declined through the second half of last year, GDP and market sector output are expected to start growing again this year, and business surveys show an improving outlook for activity, which is all going to help boost confidence. And CPI inflation is projected to fall further, possibly to slightly below the 2% target by the end of Q2 2024, and all of this comes together to create greater confidence and probably investment in the property sector. Once interest rates drop, then we're likely to see the return of debt-funded purchasers and further investor confidence and activity. But of course, a general election looms on the horizon at some point, and that's still likely to keep the number of transactions sort of suppressed as a result. Industrial remained a favourite amongst buyers over the last few months, and it's been a good time to buy for cash purchasers. We sold the Goonhaven Trade Park between Truro and Newquay earlier this year, with a rent roll of around £105,000 per annum. When completion took place, the yield paid was sub 7%, which was stronger than our 1.6 million guide price. It's shown that there is a bit of life in the office sector. We sold a property in Plymouth, let to the NHS as an office, but now used as a commercial kitchen and training centre, marketed off 2.25 million and sold for a 7.46% net initial yield. So the Southwest has been relatively resilient in comparison to other regions perhaps, and continues to attract investment when opportunities arise. And as I said earlier, occupier markets remain robust, but there's still great sector and location variance. And of course, there's still some people who are yet to refinance their property investment, and we anticipate more stock may still come onto the market as a result of that refinancing process. And there's still going to be a further sort of yo-yoing of yields probably as things try to settle down as the economy recovers. And Claire's going to be coming out with further investment commentary after Easter, and is also working on an investor sentiment survey that we hope to distribute soon to further capture the sentiment and thoughts of investors across the Southwest, which we think is going to be a really useful bit of information to look at and share as we think appropriate. So moving on from the property sectors for a moment, I'd just like to bring in Jordan Kennedy, who heads up our business rates consultancy side of the business. Business rates are one of property occupiers' largest expenses, and we are one of a very small number of firms offering business rates advice from our local bases across the region. Hi there, Jordan. Thanks for joining us.
Morning.
Hi, Jordan. Jordan, perhaps you can start us off with a quick recap of what's news in the rating sector, and we'll move the conversation on from there.
Yeah, of course. Thank you. So I suppose it would be prudent to start with the revaluation, which we did speak about a lot in the lead up to it, but we're nearly a year in now. So worth mentioning that all sectors did see an increase as expected. So nationwide, we had an increase of around 7% to rateable values. We actually are higher than that, unfortunately, in the Southwest. So we saw an all sectors increase of 9.5% in the Southwest. And that can be broken down to a 27% increase overall in the industrial sector, and even more, 36% or more for really large industrial sheds, which we did expect. And then there was a 14% increase in our region for offices, which was slightly unexpected. Actually, I wouldn't have expected to see such a large increase there. And there was a decrease in retail, so 4.7%, but again, that was not as high as we predicted. So I do think there's some work to be done in all sectors, really, to check that people are paying the correct level of business rates, as many of those rateable values don't seem to be adjusted quite as they should, with the exception of industrial, but some industrial units have seen 50% increases and more, which probably isn't fair. So I do think there's work to be done. Do
you think some people aren't challenging or really reviewing their rates as much as they should be because there's any form of transitional relief that's sort of masking stuff, or is it just a case of people not getting around to it? Or
yeah, definitely. I think sometimes there's an unawareness that these things can be challenged, which we try to spread the message that they most certainly can. But definitely, I think these increases are being masked by transitional relief, because so if we take an example, if you've got a property with a rateable value of around 40,000, the transitional relief, if their property increased due to the 2023 revaluation, that means their business rates bill could only go up by 10% last year, but from April this year, this will increase by 25% plus inflation. And from April 2025, it will go up again, so their bill will go up by 40% plus inflation. So yes, they've been masked for a while, but people are going to start receiving, if they haven't already, larger bills for this coming year, and then more increases will be seen in the following year.
And other sectors, I guess, and I suppose what I'm thinking of here is just though things may be masked and whatever else, there's still that underlying sort of higher rateable value underneath there somewhere, which is still worth having a look at, because there's some of our sectors which have definitely deserved some of the help they've got, but retail, hospitality and leisure, they're still receiving relief at the moment.
Yes, they are. So in the recent budget, it was confirmed that the retail, hospitality and leisure relief scheme will be extended for another year, so until the end of March 2025, and that discount will remain at a level of 75% for eligible occupiers, which is really, really important for those sectors, and it does recognise that they're still continuing to suffer potentially in the wake of the pandemic and with the cost of living crisis as well, but we don't know if that's going to be extended post March 2025. In the autumn budget, the Chancellor did say this relief can't continue forever. Nothing more than that, unfortunately.
Of either of the parties, and we're talking general elections and that sort of stuff, rates war, has been a bit of a hot topic of what's going to happen and reform of the rating system and that sort of thing. But has that sort of gone off the boil a little bit, that sort of chat lately?
Yes, it's not mentioned as much. And the non-domestic rating bill was passed last year, which stated that revaluations will be 3 yearly from now on. And there are changes happening in the background in the system that the VOA are already working on to implement from 2026, such as removing the check part of the check challenge appeal process. So if the government were to change, I don't know that it would be at the very front of the list of things that need to be looked at, because it's already in the process of being changed. But they do certainly speak about it from time to time.
Okay, and you mentioned to me recently that, and also, and you'll have to forgive me for getting this certainly the wrong way around probably, but it's the onus is going to be even greater on the occupier to check the facts, basically, of what they submit in terms of the detail of their property, which is another thing, which in terms of checking the detail of what's assessed and whatever.
Yeah, absolutely. So as I said, the check stage of the process is going to be removed, which means factual details of the property at a point in the future are just going to be expected to be up to date. So from 2026, occupiers are going to have to update the VOA via the government gateway as and when changes to their property happen, and they're also going to have to submit an annual return with any floor area changes, turnover changes, occupation changes. I could go on, the list will be quite long. So yes, work is going to increase for those that occupy commercial properties where it hasn't really existed before, to tell the VOA what's going on there.
And so getting the facts right, it's always important anyway with rating, isn't it? But ever, just as much as ever, making sure that whatever those base numbers are that are in your rateable value in the first place and so on are, it's sort of fundamental. I mean, I know it's fundamental, but it's sort of fundamental, isn't it, really?
Yeah, absolutely. And as you say, even more so, and they are saying there will be financial penalties for not supplying the information as well. So the landscape is changing.
Are the multipliers and so on, are they going up? Are they still holding steady? What people pay in the pound and so on?
They are going up for some occupiers. Sadly, likely those that are already being affected by a reduction in their transitional relief. So the current multipliers are 49.9p in the pound for rateable values under 51,000. And 51.2p for those that are above 51,000. But this multiplier is traditionally increased every year in line with inflation from the previous September. So that actually means this April, those on the higher multiplier, so above £51,000 in rateable value, are seeing their multiplier increase to 54.6 pence in the pound. So their bills will go up by in line with an historic inflation figure, unfortunately. So coupled with a reduction in transitional relief, many are actually going to be facing quite unprecedented increases in their liabilities, unfortunately.
And in respect of being revalued every 3 years, then when have we got another list? Or when's the antecedent date are we looking at for the next list?
So the next list will start on the 1st of April 2026. So the valuation date will be 1st of April 2024. So however the market's looking about a week's time is going to form the next rating list. So.
Okay, interesting.
Yeah.
And as ever, what the rating process for you taking on an instruction from today, following it through and actually seeing some result of that, is it as time consuming, well, not time consuming necessarily, but as lengthy as ever, or what's
currently the valuation office have 12 months to respond if a check is submitted. So that's a part of the process where you confirm the facts of the property details. And then after that comes back if you need to challenge the actual valuation of the property. So the turnover used or the rate per square metre used, it's an 18-month timescale from the date that's submitted. So you could be looking at almost the life of the rating list by the time you've carried out the necessary research or inspected the property, measured the property. So it is, in short, still a very long process to undertake. So if there are any concerns, it's worth starting sooner rather than
so the message to anybody with rateable value they want to look at is to get looking at it.
But of course any changes are backdated to the beginning of the rating list. So even though it's time consuming, it does correct itself in the end.
Well, I see in the handouts in the side of the screen that we've put in a rates consultancy leaflet in there, so everybody's welcome to download that as they wish. I should have actually said at the start, this will be being recorded, this webinar, so it will be available later on if anybody wants to look at it on YouTube. Thanks, John. As ever, that's a really useful update on rates. So, key things for the next few months is looking at anything that people want you to look at, and then that is very interesting that we're now at a point that the snapshot for the next rating list in 2026 is just what the market's like now, which is interesting. Okay, great. Thanks, Jordan.
Thank you.
Right, I'm watching the clock a little bit, and I think we're going to move on to talk about the development sector now with Stephen Maycock, if Steve's around. Hopefully he is.
Hi, good morning, Alan.
Hi, Steve. Hi, Steve. All right. Thank you for joining us today. Right, Steve heads up development services service within Vickery Holman. And Steve, what's going on in development services at the moment?
Yeah, well, I mean, I guess, the residential market to start with, which we've seen now stabilise. The fall in mortgage rates at the start of the year seems to have prompted a bit of an increase in market activity. And if you speak to agents on the ground, most are now reporting a noticeable rise in new buyer inquiries. Mortgage applications are up, at the highest for 15 months now. We're seeing annual price changes now move, back into positive territory once again as well. Sales agreed, are up considerably. In February, around 25% compared to the same period last year. And that's also now up on the 17-19 average, which is where we look to for a sort of more normal pre-COVID comparison.
Mm-hmm.
So yes, there's growing momentum in the market, and it's in a much better place now than it has been for, probably 18 months. But there is still some uncertainty. We actually saw mortgage rates tick back up in February. The market certainly remains very price sensitive.
Mm-hmm.
So accurate pricing is really important. But yeah, generally there's a growing sense of optimism in the market, I would say.
Do you think amongst buyers of the end product, they are just waiting for that actual confirmation of when rates are going to properly start coming down, which we still haven't? I mean, we know it's weird. We feel like it's coming. I think history sort of proves that when interest rates hit a bit of a high point, they tend to plateau for a little bit, and then it takes them a minute or two to start coming down. But I guess it just feels to me like people are just waiting for that first 0.25% or something, first indication that that's the way we're going to go, and then all these inquiries will translate into increased activity.
Yeah, that's quite likely. I think we are likely to see mortgage rates continue to fall this year, which will provide home movers with that stability and certainty in terms of what they can afford. So I think we will see a return to more normal, more conventional levels of activity this year. But those affordability pressures are still there, and they will continue to persist. So I think. Sorry.
No, we just need those rates to sort of edge down a little bit. But so that's all about affordability on the buyer side and stuff. But are we still in this build cost sort of situation we've had for the developers over the last couple of years or so? Is there any news or any update on where we're at with build costs? Have people just got used to it, or is there any movement? Are things looking a bit brighter?
Yeah, I mean, over the sort of last year, the rate of build cost inflation has eased, and that's largely been driven by, a slowdown in construction demand, and a fall in material costs. So prices rose by around 3.9%, 4%, I think, last year, down from just over 11.5% in the previous year in 22. That's according to BCIS data. And a further easing is now anticipated this year, with forecasts for cost increases of around 3%, I think, with marginal annual falls thereafter. So, the forecasted downward trend is obviously good news for the sector. But, I guess it's important to note that, there will be other development costs to be managed. Particularly around building regs, environmental standards, biodiversity net gain, which came into force at the end of last month. So, there's a bigger picture, I guess.
Yeah, I think that's interesting. I know from our point of view, from selling development land, which we are, we have got a few development projects that we're trying to sell across the region, and this last 12 or 18 months has been a real challenge for developers. Because of all of the above, I suppose. But if we're starting to see a bit of a glimmer on the build cost and the end product market is improving, plus borrowing might ease, then that's hopefully a few ingredients to ease the situation all round, hopefully, and unlock a few things happening.
Yeah, I think. Sorry, go on.
No, I was only going to say, and so, does that mean we think there's going to be some more confidence around amongst developers as we go forward, probably?
Yes, I think, yes, I said, I think there is a bit of confidence returning to the market. Certainly from the developers we're speaking to on a regular basis, most of which are SMEs. there's a growing sense of optimism. Sale rates are up. Cost inflation is down, as we've talked about. And most are sort of now eagerly just trying to replenish their pipelines. So I think with sentiment improving, we will see demand for sites continue to increase this year. And we're seeing that on the ground, with more requests for, secured lending valuations and the like. So I think the market is sort of, cautiously pressing on, really.
And of course, there's still, I don't know what the actual exact figures are, but there's still such a need for more and more housing, in terms of delivery rates, then it has to unlock itself and get on again, doesn't it, really? I mean, I know we've been ticking over for the last little while, but, that demand for new product, new housing is certainly not going away, is it? So,
No.
Because previously, I don't know, a few years ago, perhaps now, we've talked about, thousands of delivery expected in the region or across the country and this sort of thing. And we're still not meeting delivery that's required, I presume, but that's my guess.
Yeah.
But, you can tell me from...
No, clearly we're still well behind, the sorts of numbers of homes that we need to meet, current and anticipated future levels of demand, both for home ownership and to rent, there are the usual issues around, increasing costs of obtaining permissions, and delays in getting those, applications approved. And that's been the theme for sort of several years now, really, with, under-resourced planning departments, not being able to process applications quick enough.
Yeah.
And that particularly hits SME house builders, who will often have their capital tied up in, just one or two projects, so those lengthy delays can bring those businesses to a grinding halt, really. We have seen that with some firms being driven out of the market. So certainly planning is still a sort of major issue, which is impacting delivery, along with land availability, land prices.
Pricing, everybody's expectations and what they're getting out of this deal sort of got to align somewhere, haven't they? And if people aren't persuaded to get off their land and move it on to somebody else at the prices that the market's dictating, then that's just going to stagnate things further, isn't it?
Right.
As you said about planning there, and I suppose planning and housing delivery and so on will probably form part of political sort of discussions as we head into elections and so on. But I guess, almost is the simplest possible thing that, just needs more investment in the system, really, and that might help things get delivered, mightn't it?
Simplistically, we think, more planning officers, more resource, to be able to handle and manage the volume of applications that are coming through the door, really. So we look to the next government and to see what that looks like going forward, really.
Yeah, it could be interesting if we, I'm sure we'll be holding something like this in the autumn, where we're at by that stage in terms of politics, whether we've got somewhere by then or not, who knows? But it's going to be an interesting few months ahead, but hopefully not so interesting that it takes everybody's eye off the ball from actually just getting on with things. And I think we've been having a sort of rolling series of a few little case studies there on the screen whilst we've been talking, Steve. And there's a development services handout in the handout section on the side of the screen. So if again anybody wants to download that, they're very welcome to. So thanks for now, Steve. Thank you very much indeed. Really appreciate your interesting stuff there. So another really, really important sector for us in the Southwest is leisure. And I'd like to bring in Mike Easton onto the stage for a quick few minutes on the leisure sector, if Mike's around. There he is with a suitably coastal looking view behind him. Morning, Mike. Thanks for joining us. As ever, leisure, massive employer in the Southwest, always under scrutiny, always hits the news, how good or bad it's doing and that sort of thing. We're about to go into another season. What are you hearing out there from your contacts in the trade?
I think there's a bit of caution out there at the moment. Most of the guys are sort of holding tight on bookings. I think fundamentally we've had a bit of a problem with bookings over the years because people do it later, and it's easier to cancel than it's ever been. So, I think most of the guys out there are a little bit cautious about the year ahead. Easter's early, which is never that helpful. We needed to get out of the wet season and into a bit of heat, which we haven't quite got there yet. I think there's a bit of a hold tight at the moment from an operator's point of view.
And does that sort of translate into what they're doing with the marketing of their premises as well? Is that sort of a little stagnant at the moment, or what's the actual market like?
The market's okay. I mean, I think we got caution across the piece really, but I think we came from quite a big high in the COVID years, where there was a lot more cash around, and I think people are just a bit more cautious on committing that cash at the minute, and they're earning a little bit in the bank. I think we've gone through a period once again where there was a view that perhaps there'd be a few insolvencies and liquidations, and that will drive values down. Again, it hasn't really happened.
No.
I don't really expect it to happen, and I think we're just ticking along. I think there are still a few buyers out there. They're just waiting to see the better product. I think one of the problems we've got at the moment is that the good operators, even though they may well want to move on, they're making good money, and actually prices are a bit static. So it's a case of, let's trade it through, wait for prices just to improve a little bit more, and then make a commitment.
Yeah, you think prices will come back then? Is that what we're saying? Or, things are slightly, I don't know about undervalued, but you think that there's room for prices to increase in the market going forward then maybe?
I think it's a bit of a mixed picture, really. I think prices, it's very easy to put them up. It's much more difficult to bring them back, and particularly when ultimately we're talking about operational businesses, so they're making money along the way. It's quite different to residential in that regard. So I think we're just going to get a bit of a leveling out this year. Personally, I'm starting to see a lot more people that are sort of looking to retire from the trade, the sort of the longer term guys, and it is a bit of a sort of need to sell rather than like to sell market at the moment.
Okay.
So what we're tending to see is some of the longer serving operators where they've done their time really, and they're wanting to move on.
I'm probably ridden out a few more years than they thought they might have done. I know earlier I was saying let's forget about talking about COVID, but they perhaps would have cashed in at some stage in the last few years, but with ups and downs and peaks and troughs of what's been happening and other restrictions, they've perhaps pushed on a bit longer. So as you say, there is a life sort of cycle to your market, I suppose, perhaps more than most, maybe.
Definitely.
People hang on in there.
Yeah, I think the biggest thing, and I think we mentioned this earlier in the year, the sort of the in and the out guys, the sort of the 3 to 5 year plan guys, they're the ones that have got to hold fast for a little bit longer. And it's more of the longer serving guys that are tending to commit at the moment, just because they've got a need for an exit, rather than a sort of, sell, build up another business again.
I think we were chatting a while ago and you were saying that the leasehold side of things is perhaps picking up a bit, or has picked up, just as being a sort of cheaper entry point for operators, perhaps. Yeah,
it's definitely price sensitive. We went through a period, probably winter last year, where some of the larger leasehold sites were difficult to move on. That was cost of living. There's a lot of negativity in the trade. I think we sort of come out of the other side of that, and we're tending to see premiums probably up to about 50,000, but still transacting quite well, and we're quite busy from that side of things.
You mentioned it. I should have picked up on it earlier, really. But the whole sort of cost of living, utilities, that sort of thing. It wasn't quite such a desperate sort of 12, 15 months or so ago. We were, everybody around the table was pretty gloomy about where we were heading in terms of costs and so on. But I suppose it sort of blended itself across a series of challenges, maybe for the sector, rather than just it's utilities bills that are going to get us sort of thing, maybe.
Yeah, I think ultimately we're a sector that's actually dealt with quite a lot of challenges for the last 20 years, and then they just maintain again. I think though that there's a bit of the reality checker is that some of these businesses are doing very well and pushing headline revenue, but ultimately they're making no more in their bottom line. So conversion's harder. There's still cash, being made, but ultimately, it's being eroded by cost of staff, cost of materials, cost of utilities.
And what booking levels, as you said at the start, it's so much harder. People book so late. The interesting point you made about it being never easier to cancel than it is nowadays. I suppose everything just a click away, and so that's a big challenge for everybody, isn't it? Have you heard much amongst operators about how things are looking ahead, or is it just so short term these days that even they don't know yet perhaps what the outlook is?
Yeah, I think the holiday park market, I think they tend to have a better understanding of what's going forward, because they're usually week-long breaks. Same with the sort of larger hotels, but then anyone else that's sort of sitting in behind that, it's a little bit harder for them to gauge. I think just on the accommodation side, we've had a sort of a run through of all the new hotel developments in the southwest. We've only had one opening in the last 4 months, and there's only one that's probably going to open this year. That's sort of helpful for the existing operators. It gives them a chance to consolidate and maybe make plans themselves. I think across the piece, most of the bigger guys haven't tended to want to commit too much money on the project, which is always a shame. It's sort of, that's been stifled. But we might see a bit of a change of that as the year comes on. I know we talked about rates. That makes a bit of a difference all round. So at the moment, like I say, most of it's sort of sit tight, hold fast, trade through, go again. More
hope for a good summer and recap in the autumn.
Yeah, absolutely. That's pretty much it.
Okay, well, and the politics side of it, I suppose. We'll wait and see. I think it's keeping things going, like the rating relief, isn't it, and that sort of thing. Supporting your local really is the big thing, isn't it?
Yeah, I think. I mean, I've mentioned a few times on webinars that we've done before. The rating stuff is super helpful. It hides a little bit, I suppose, for when we're looking at trading businesses and profits. And at some point, they will take it away, and that more likely is now going to be March next year. But the key principal change to the whole sector is going to be VAT. If any party picks that ball up and runs with it, I think they'll probably get a huge amount of support from quite a lot of hoteliers, publicans and restaurateurs.
Yeah, and it's a huge sector at the end of the day. Yeah, absolutely.
Yeah, very much. I mean, it's fourth biggest employer in the UK. They're under pressure because there's another rise in minimum wage that has an impact, and ultimately these guys are only making money on the products that they sell. So that's why we're getting this sort of stifling of profit, really, despite the fact that actually some of them, headline revenues actually still climbing quite nicely.
Yeah, great. Yeah, good. Okay, Mike, lovely job. Thanks very much for that. We'll come back to you if we've got any questions if we have at the end that need to bring you back in. Thanks very much for your time there, Mike. Brilliant, thank you. I'm just seeing in the handout side of the screen on the side, there's a few more getting in there. So if anybody wants to pick up any of those downloads, do pick those up during the rest of what's still to go. So I think we're into any questions that we've picked up along the way now. And I saw somebody talking about demand for warehousing somewhere. We talked about sort of core locations, perhaps down the motorway and an A30 further west and that sort of thing. But somebody was asking about demand in Barnstaple for warehousing space. Zach or Joe, do you want to come in on sort of the slightly more self-contained locations around the southwest? I know down in Cornwall we find demand in the more let's call them self-contained locations, not quite on the arterial route and so on, but still seem to just sort of support their own local market, if you like, and still seem to pay decent rents because stuff's short. But I don't know Barnstable in particular.
That's more Zach than it is me, but I suspect you'll talk about Stib Cross and. I was just thinking,
I think with the cost of everything, especially out of Exeter, I think there are opportunities elsewhere. I think if you look at what, say, Onyx Business Parks are doing in Barnstable, where they released that site, small units again, but strategically they went off like hotcakes. There was a lot of interest in those units, and likewise, Mercury Business Park in Clumpton has also pretty much sold out now. And I think strategically there's more opportunities to come as well in those locations.
Okay, good. Have we got any other questions in there? Not really. I don't know. Can't see any much else in there. I know we've got Jordan's poll about rates in there, which had a few went up slightly, others not much change, others didn't know what their rates were, but maybe our chat today was a bit of an encouragement for people to talk amongst themselves or amongst their clients about what's happening with business rates. I'll just get back to the chat again now, see if we've got anybody else dropping in there.
There's a comment about retail between Bristol and Exeter.
Okay.
Actually, we are getting quite a few requirements for some big multiple retailers. Actually, in towns that maybe 5 years ago would have been a bit of a struggle with. Actually, yeah, I think there is opportunity out there, and I guess there's a lot of vacancy in towns like Taunton, for example, which historically shouldn't really suffer that badly. It's got good footfall, it's an affluent area. I think retailers are starting to look for opportunities. Also, people like Edinburgh Woolen Mill just taking a prime shop in Tiverton, and actually places like that seem to be. There's opportunity there. I think actually, if you look at the values as well, they're relatively low right now. If you look at vacant retail, especially in the auction houses as well, there could be some opportunity there. I know a few of our clients are looking at those type of locations too, thinking, chance to acquire a whole building.
That's a good point, and one I had in my mind to pick up actually, and I'd forgotten about. But actually, the value for money in offices and retail probably is for the right thing, for the right buyer in the right place, and also there's a lot of things to align. But there's value there, isn't there? Really good value for money, bricks and mortar wise, if people have got an idea of what they want to do with something.
And likewise, an affluent town, places, companies like loungers, they're on the acquisition trail at the moment. 3,000 square foot in a good town. Could be an interesting one.
Yeah, particularly those towns further in the east of the region, which have got generally bigger populations and so on, are a bit more of a safe bet probably. Yeah. Okay, we're on our slides here because we're heading towards the last sort of 5 minutes or so. We're talking about webinars that we've got upcoming. So if anybody wants to register for those, particularly the commercial property for business owners update on the 25th of April. Go onto our website and you'll find a place to register for that. And all of what we do is recorded generally, so it is available to view on YouTube, on our YouTube channel at a later date, as you wish. So I guess if everybody is done with questions, and we've have seen those handouts, and obviously contact us after the event if you've missed a handout or something like that, or have got any specific query, that's absolutely fine. Do just speak to us. We'll be doing something like this in the autumn and back with in-person events in the beginning of 2025 is our plan at the moment, and obviously other webinars along the year from specialist parts of the business. So I don't think there's much else for me to do than thank everybody for attending today. It's really nice to see so many people on the call. So many people stuck it out to the end, which is really good. Thank you very much. I do hope you all have a really good Easter weekend when you get there. And I'd just like to say thanks very much for listening to us here at Vickery Holman today. Thanks very much indeed. Goodbye.